Greetings, my beloved clients and friends. So I want to talk about something today that is not immediately apparent to be tied to current events, but in the end you'll see it is, because we're going through a massive repricing bear market in the stock market. So what I want to talk about is the difference between a concept or a cause and a company and an investment. The difference between those three things: a concept or a cause, one; a company, two; and an investment is a third different thing. Okay, so let me give you an example what I mean by that, and I'll use Tesla. So Tesla, you could say, has a cause, and their cause is to accelerate the world's transition to sustainable energy. And someone might hear that and say, well, that's a great cause. I want to invest in that. But a great cause doesn't necessarily make a great investment, okay? And it doesn't even necessarily make a great company. So, but a lot of great companies start as a great cause or a great concept. Like, let's say Zoom, for example, would say, well, what if we could do meetings virtually? What a great concept, right? That's a concept, okay? Doesn't necessarily make a great investment. And so that cause or that concept has to turn into a profitable business or a company, right? And for that cause to successfully become a company, or a good company or a good business, it has to have many things, but the two big things is an excellent strategy and excellent operations. And so some companies that come to mind that are great operators or have great strategy, Home Depot is an example. They're in the same business as Lowe's, let's say. I mean, often across the street from each other, and direct competitors. But Home Depot has double the operating margin of Lowe's consistently for years. And so it's just a great operator. And another company that's a great operator is, now they're both great companies, but in my opinion, Home Depot is better. They're just a better operator. And another example would be like McDonald's. When my kid was in school, I'd take him to school every morning, and we'd stop and get something to eat. And most of the time we'd stop at McDonald's. But occasionally we would stop someplace else, Starbucks or Chick-fil-A or something like that, Jack in a Box or something. And we'd always go through the drive-thru. And I was amazed at how quickly McDonald's gets people through the drive-thru, how they work that line. There's no comparison between them and any other drive-through place. The speed at which they move that line. So they're just an amazing operator. Okay, and in business you have to have, you need to be a good operator, and you have to have a good strategy, like a go-to-market strategy. So the two big things to determine if a concept is going to become a company would be, does it have product market fit? And is it able to scale? And a lot of great concepts are not able to do that. Most of them. A few of them are able to the visionary was also a good operator and also a good strategist, or he partnered with someone that was a good operator and someone that was a good strategist, because it's not the vision alone that turns a good concept into a good company, or even a good investment. And so one company that I think is struggling with that is this company called Arcimoto. And it's this three-wheeled electric vehicle, and it's a great concept, but they're just not great operators, and they're not great strategists. They had their go-to-market strategy was this thing that they called multiple shots on goal. And it's a terrible strategy, because what their concept was to have all these different iterations of this three-wheel vehicle, and they keep adding them. They keep adding more and more iterations of this vehicle, and so they're spreading themselves into more and more and more and more target markets, and it requires so much capital to attack even one market. And they're trying to go after multiple markets, and they don't have the capital to do it. They don't have the resources to go after so many markets, because you want to go into one market and dominate it and be effective, and then from there maybe you could branch out, right? That's a better go-to-market strategy. So their strategy was terrible, and they're running out of money, and it was clearly predictable. I did a video about it over a year ago, but compare that to Tesla's go-to-market strategy. Now, Tesla, like we said, was a great concept, a great cause, but it's also proven to be a great company. Elon Musk is a great operator and a great strategist. In addition to being a great visionary, his strategy was this, and he wrote about it probably over a decade ago. He said, this is going to be our strategy. We're going to come out with a high-priced, low-volume vehicle. And that was the Roadster. And I think they only made maybe 1,000 or a couple thousand of them. And it was very high price. I think it was around 225, 250,000, right? So it was a high-price, low-volume vehicle. And he said, we're going to learn from that, and we're going to make mistakes. And then we're going to come out with a lower-priced, but still high-priced, higher volume, but still not huge volume vehicle, right? So it's going to be lower priced, higher volume, and that was the Model S. And it did, and it came around between 75 and 100,000, and they made a lot more of them, like 15, 20,000 a year, but they were still losing money. It was not enough volume to be a viable business. And he said this before they even made the Roadster, and before he said, the third thing we're going to come out is with a lower priced, high volume vehicle. And it took them probably almost a decade before they realized that. After they made the Roadster, after they made the Model S, then they came out with the Model 3, and it came out around 45,000, and they made thousands of them, and they've made hundreds of thousands, and it got them to 500,000 in vehicle production, and then last year they were just under 1 million. Okay, and so that was his go-to-market strategy, and it was an excellent strategy, and he executed it well, and he was a great operator, and his factories are very efficient, and that got them to profitability. So they had a good strategy and a good operation, and it became a great company. Now, a great company is not necessarily a great investment. And like we said, a great concept is not necessarily a great investment. So what makes a great investment, and what distinguishes it from simply a great concept and a great company, is the price you buy it at. Don't pay too much for a great company. Because you could find a great company. There's not that many of them, but you could find them. But if you pay too much, it could still be a bad investment. Okay, so let me give you an example. Let's say you're looking for a house, and you find a house, and it's the floor plan you want, and it's in a great neighborhood, and there's great schools, and there's low crime, and there's great weather, and there's nice amenities like restaurants and entertainment, and it's just everything you would want in a house, right? But it's going for $3.5 million. And all the other houses in the same neighborhood with the same amenities and the same floor plan and the same schools and amenities and everything are going for $750. It's a great house, but and if your plan was to buy it and sell it for profit, you shouldn't do it if you have to pay $3.5 million for it. Now, if you don't care about the money and you're not planning on selling it, maybe you would buy it, but it would be a terrible investment, because as great as it is, the price was just way off. okay? And so great companies, to be a great investment, you got to be careful with the price you pay for it. And what has happened is that the price had, largely due to COVID and the reaction to COVID, that massive amounts of money was blown into the economy. Prices got way out of whack, especially in the stock market, also in the crypto market, maybe in the housing market, but especially in the stock market, especially in the growth stock market. Prices were ridiculously high. True, they were great concepts. True, they were great companies, but the price made them not a good investment. Now, let's say that $3.5 million house didn't sell and they lowered the price to $2.5 million. Would that make it a great investment? It's still too high, right? And it's not cheap yet. It's come down from its high, but it's not yet cheap. So let's say it still didn't sell at 2.5 because no one was dumb enough to pay for that. And so it drops to 1.5. Is now it a great investment? No, it's probably still too high, right? So, and the other thing I want to say is there's a difference between something being cheap and something being off from its high, okay? Because there's a lot of companies right now that are off their highs, meaning they've dropped 30, 40, 50%. That does not mean they're cheap. It could simply mean that they're off their high. Like this house that was listed at 3.5, now it's down to 1.5. Let's say it finally drops to $1 million. And now you say, well, there's nothing else for sale in the neighborhood, and I'm paying a little bit too much, but it's a great house and I probably won't get hurt too bad. So at some point, but let's say there's this extreme fear and then all of a sudden it drops to 750 or 500. Then not only is it a good house, but it's also cheap, okay? It's not only good, it's not only off its high, but it finally became cheap, okay? So how can you tell if something is cheap or simply off its high price, right? So let me give you an example, because at some point the market's going to become cheap because fear is setting in, reality is setting in, and people are actually starting to look at what's this thing worth, and there's a repricing going on, right? And so, and I've said before, some things are actually looking cheap. Others, while they've come off their high, are not yet cheap, and not everything's going to become cheap at the same time, right? So some things will become cheap, meaning a good investment, because it's a good concept, it's a good company, and it's at a good price. Then it becomes a good investment. And some things are going to hit that level before others. They're not all going to cross the finish line at the same time. Okay, so what determines if something is cheap? So let me give you an example. Let's say you went into the bank to get a CD and you're looking for $1,000 a year in income. Well, for the longest time, interest rates were at 1 or lower. And let's say at 1%, to get $1,000 income, you'd have to pay $100,000. You'd have to pay $100,000 to get $1,000 a year in income. That's a 1% CD. That's not very good, but it's been the case for many years. So now that Powell's raising interest rates, now let's say you go into the bank and CDs are paying 2%. Okay, so now if you wanted that same $1,000 income, you only have to pay $50,000. $50,000 at 2% is $1,000 a year in income. So the price of that $1,000 income has dropped 50%. Is it cheap? No. Is it off its high? Yes. Okay, but historically 2% is not very good either. Okay, 2% is not an attractive interest rate on a CD. But if you've been in 1% the whole time, you see 2, you might start getting excited. But historically, it's not very attractive. Let's say rates drop to 3%. Rates go up to 3%. Now it only takes you $33,000 to get that same $1,000 of income. So that $1,000 income is becoming cheaper. Let's say rates go up to 4%. Now it only takes you $5,000 to get $1,000 income. So that $1,000 income is becoming cheaper. At 1%, it costs you $100,000. Now it only costs you $25,000. Is that cheap yet? Not really. Historically, 4% isn't that good. Let's say it goes up to 5%. Now it only takes you $20,000 to get a $1,000 income. Now would you do it? Historically, that's kind of decent. So at that point, we'd say, okay, it only cost me $20,000 to get that $1,000 income. That's pretty cheap. That's a good investment. Okay, and so that's the difference between the price coming down and something being cheap. It went from 100 to 50 to 33 to 25 to finally at 20. You could say, okay, it's cheap enough to be considered a good investment. Okay, and that's what we look at when we look at investments. The illustration we talked about was basically talking about interest rates. In the stock market, we talk about PE ratios, but they're the same thing. You say, if I make $1,000 on a $100,000 investment, you would say that's 1%, which would be 1 divided by 100 is 0.01 or 1%. But in the stock market, we would say that's a price to earnings ratio of 100. The price of 100 gives you earnings of 1. 100 over 1 equals 100. And that's a PE ratio, but they're the same thing. 1%, 100 PE is the same thing. 2%, 50 PE is the same thing. 3%, 33 PE is the same thing. 4%, 25 PE, they're the same thing. 5%, 20 PE is the same thing. Okay, and so investing, if you look at, say, what is expensive, what is normal, and what is cheap, historically, an investment giving you 1, 2, 3, or even 4% wasn't that great. That would be considered unattractive or expensive, right? Depending on which way you look at it. And once you get into the 5, 6, 7% range, that would be considered normal or fair or decent or typical, right? And whether you're talking about interest rates, whether you're talking about real estate, which calls it a cap rate, or whether you're talking about the stock market, which calls it a PE ratio, that would be normal. So a 5, 6, 7% on interest rates would translate into 20, 17, or 14 as a PE ratio, approximately. And those are normal PE ratios. Now, if you get into interest rates, talking about 8, 9, or 10%, right? If the bank was offering you 8, 9, or 10% on a CD, you'd be excited. That'd be historically very good, and you'd want to lock that in. If the government had government bonds or high-quality corporate bonds paying 8 or 9 to 10%, you'd be all over that, because that'd be historically very good. If you could buy real estate at a cap rate of 8 or 9 or 10%, you'd be all over that, because that's historically very good, also known as cheap, right? If stocks were in a PE ratio of 12.5, 11.1, or 10%, which is the equivalent of 8, 9, 10% interest, you say, well, that's really cheap, okay? So that's when we know something is cheap rather than just off its high, okay? And that interest rate can also be used to compare two investments. So if you're looking at real estate, you're saying, well, cap rates are about 4%. 4% isn't that good, but it's better than 1% on a CD or 2% on a government bond. So relatively it's better. And a PE ratio of 25, which equals 4%. You say, well, 25 is kind of high, but it's better than 2% government bond or 1% CD or a 3% cap rate. So depending on the market you're in, investment money will flow to the one that has the most attractive returns. So, that's, you could use that method for investments that pay an income. CDs pay interest, bonds pay dividends, real estate pays rent, corporations pay earnings, and those are all forms of income, and you could determine a multiple to that income to see what's a fair price to pay. Now, that works only for investments that pay an income, and it works best for investments that pay a consistent income, like a bond or a CD. As their income becomes less consistent, right, earnings are up and down or negative, or that method of determining if something is cheap does no longer works as effectively, or often not at all. So for example, gold. How much do you earn when you're holding on to gold? It's not an investment that produces an income. So to ask the question, is gold cheap? Using the method we're talking about, there's really no way to answer that, because so it fails in trying to value gold because it doesn't produce an income. Same thing with Bitcoin. Is Bitcoin cheap? I don't know, because it doesn't produce an income, so I can't really compare it to anything. What about a company that's losing money? I don't know if it's cheap or not, because it doesn't produce an income, or it doesn't produce an income that's consistent enough to use that to estimate it. But companies that produce a consistent income, it's a lot easier to value them, similar to bonds or CDs or real estate that produces a consistent income, and then to determine, is it at an attractive price or not. So when we talk about, and at some point the market is going to become cheap, because it had gotten expensive, especially the growth side. They were trading at like 100 times sales. That's the top line. That's not even the bottom line. And there was no bottom line. So those companies were just expensive. But they've come down to like 10 times sales, these really high growth SaaS companies, and it looks like they're going to come down to 5 times sales, and we're still not even looking at the bottom line. And companies with earnings that were growing were trading at 50, 60, 70, 100 times earnings. Doesn't make sense. And, they're going to come down to 30, 25, 20, and then, they'll start looking cheap. Okay, so that's why we say some companies are actually cheap right now, because if you look at their earnings and you look at their price, that's a decent price to pay for those earnings. Some companies are not cheap yet. When I say that, that's what I mean. Okay, so I hope this helps in how we're evaluating managing the portfolio and trying to get into seeing opportunities of companies that are cheap and getting out of ones that look expensive, and maybe even shorting the ones that look super expensive, either shorting or buying a put on them. Okay, so that's how this conversation about the difference between a good concept, those concept stocks are getting obliterated, and even good companies that were trading too high, they're getting crushed, and the ones that are actually good investments, meaning they pay consistent earnings and they're trading at a reasonable price, those are the ones where we want to be in. The other two are the ones we want to be out of, and possibly even go the other way on. Okay, so hope that gives some insight into our strategy to navigate through this difficult market. Hope you guys have a great day.